Let's talk about the case for equal weight, though, because joining us now is Sherman, DoubleLine Deputy Chief Investment Officer. And I'm so excited for this conversation because usually we talk about bonds with you, but today we're talking about this ETF from DoubleLine, the Fortune 500 Equal Weight ETF. You launched it in February, or rather late January, and it's doing pretty well versus its benchmark of the Equal Weight 500. But you think about the equal weight relative to the rest of the universe, the market cap weighted indexes out there, and it's just so hard to compete. What actually changes that?
Yeah, well, I mean, if you look at it, I mean, everyone's been professing about the concentration of the S&P 500 for really going on years now. And if you look at the top four stocks, it's it's over 23% of the index. You look at the tech sector alone, it's almost 33% of the index. And so we always profess diversification in this business, and people talk about indexing being a cheap way to do so. But the problem is that it may be cheap on a cost basis, but you're significantly paying up in terms of the multiple of earnings. And we just saw the CAPE ratio on the S&P 500 cross over 38 recently, which, it's rarely been in that territory through history. We see the trailing earnings over 30 times earnings on the S&P. And when you transition to something like the Fortune 500 Equal Weight, you get down to sub 20 on a multiple, which isn't inherently cheap by historical standards, but it is meaningfully cheaper than these mega cap weighted indices today. And so what you're finding is that there's this enthusiasm and jubilance of this new administration, tax cuts, that's all we hear about. But there's also the risks on the other side when we talk about the tariffs, the immigration policies and the like. And so the question one has to ask themselves is that, will this momentum continue in these markets? And do you really want to continue to make that bet? And so the way we've been talking to clients about thinking about their U.S. equity exposure is that there's nothing wrong with owning the mega cap. If you want 30% in mega cap and you want this tech sector, why not just go out and buy something, if you're an ETF investor, and do something else with the piece of your portfolio to ensure that you're getting a bit more diversification. And so we think things like the Fortune 500 Equal Weight, the DFVE product that we're running, is something that can be very helpful in today's market.
Well, let's talk about the Fortune 500 index that you're using, because muscle memory, of course, we go to the S&P 500. Why go with this 500 stock index? And also the design of this ETF in particular, I believe you only have 460 of those stocks.
Yeah, so what it is that there's a lot of people, when you mention Fortune 500, a lot of people actually think it is the S&P 500 because of just that number being in both of those indices. But the difference between the S&P 500 and the Fortune 500 is the Fortune 500 is actually a rules-based process that's based upon revenue. And so it's looking at the U.S. companies, both public and private, that are domiciled in the U.S. So it's a U.S. kind of first type of idea, one. But secondly, it's using revenue as the criteria for inclusion. And so it simply just ranks them based on, their contribution to overall revenue in the U.S. economy. And so if you think about the S&P, it's one that's being judged by a committee. Nothing wrong with committees making decisions, but it isn't as rules-based as people think. And so there's this inclusion and exclusion mechanism that comes from some human judgment there. And so, again, nothing wrong with doing that. People have been doing that for many decades now. But what you find, because some of these companies are indeed public, you can think of something that, let's use SpaceX, for example, generates a lot of revenue, but it is not publicly traded. And thus, you can't invest in those in an ETF wrapper. And so from that standpoint, what we're doing is looking at these public stocks out there that have enough ability to trade them, have enough free float to be able to do so. And then we pursue an equally weighted methodology. So each year when the Fortune company releases its new list and the new 500 they did earlier this year, we reconstitute the index, we rebalance it on a quarterly basis to achieve these target weights so we don't end up with that concentration effect that we're talking about that riddles some of these other indices.
Jeff, I think of DoubleLine, I think of bonds. Are you branching out into equities? Are you going deeper into equities as the returns have just been so dazzling? I mean, we're looking at 25, 30% for the S&P 500 compared to, 9 or 10% for the best bonds.
Well, Matt, I know you think of us as a bond shop, but we have been running equity products for over a decade now. And so this is not something that's a new foray for us that we're trying to do me too, or we're jealous of the equity market. It may shock you, but even as an investor, I own stocks as well. And so from that standpoint, when we find good ideas that we think are useful to our clients and things that we want to invest in, that's when we launch products in this space. And so we've had this methodology and we've had the exclusivity on it for a long period of time, but just given where multiples had been over the last couple of years, we decided that it was time to really launch a product like this. One. Secondly, with the development of our ETF platform, we thought it brings more diversity to the overall platform, and that's something that we really want to focus on. And so it's not that we're changing our stripes. This is something that we invest in stocks, we invest in bonds, and we continue to do so. And so as you may have noticed, Matt, we just launched another ETF a couple of weeks ago in the bond space. And so our complex is now up to 7 ETFs under the DoubleLine brand. Plus we have the 3 that we sub-advise under the State Street Spider brand as well. So we're just going where the market is asking for products from DoubleLine, and using our expertise and our ability to analyze markets is what brings us into this marketplace today.
Well, Jeff, rest assured, I am following what you're doing in the ETF space very closely. But in the time we have with you, I do want to get to the bond market proper. Of course, we're counting down to that Fed decision on Wednesday. Yep. Next week is the last week that actually matters in 2024. What are you expecting, and how does it filter through the Treasury curve in particular? That has been the epicenter of volatility in this market, and I'm wondering if that changes anytime soon.
I actually don't think it does change. I think the epicenter of volatility is the rates market. It will continue to be the rates market, at least in early 2025. And so I know that a lot of people talk about the tightness of credit spreads out there, especially in the corporate bond market. And, it makes a lot of sense given the deleveraging that's taken place in that part of the market, just the benign default probability today, given the earnings growth on that side as well. So when you look at the bond market, it hasn't corporate spreads or even credit spreads that have been volatile. It's really been the rate side. And I think that that's going to continue next year. So I heard your previous guest talking about, well, maybe the Fed isn't as accommodative, and we completely agree with that. I do think you get the cut next week. You'll get it on Wednesday. I'm really skeptical to see if we get any more cuts until kind of the back half of next year. And why that is that we still have to digest these new policies that are coming through. And so it's still to be determined on what the actual policy will look like when it comes to the immigration side, when it comes to the tariffs, and is it bluster, is it just negotiation, or is it factual? And I think that's going to be a big driver. Because, the flippant response is that, well, if there's tariffs, it causes inflation. But if it causes a lot of pain points, it could actually cause job losses too. So it could be ultimately disinflationary and somewhat problematic to the overall economy. So I think with the jury's still out, we got another 38 days or so till we'll see the pen strokes come out on executive order. And then we're going to have to see how the corroboration is through Congress to see what actually does come through. And so I don't think there's some clear cut. I see a lot of people saying that, there's an obvious trade in today's market. I think the obvious trade is to be patient, enjoy the yields that the bond market's giving you. And if you get a little bit more of a rate backup, it makes bonds very attractive going into 2025, because we're talking about a stock market that's nearing, the high 20% gains for the year. And so it's going to require a little bit of rebalancing too. So all in all, I think rate volatility will continue, at least in the first quarter or so, until we get some more clarity on policies. But the economy is still in a decent shape. It seems that thus far we've negotiated this soft landing. And so when I look at the bond market, there's real yields. That is, the yields are outstripping inflation, but inflation is still beyond the comfort level of the Fed, which means that it's probably not likely that you get a cut for the next few more meetings unless there is some really improvement in the inflation data.
All right, Jeff, it never feels like enough time, but it's great to get some time with you on this Friday. Appreciate you waking up early for us in California. That is Jeffrey Sherman of DoubleLine.